Hello and welcome to today's webinar. My name is James Hughes, Chief Market Analyst at Alpari UK. Sorry if it's taking a little bit while for you to log in then. Inevitable technology issues have come up, so sorry for delay. But this is the Introduction to Forex webinar. It is the first webinar in our Trading Essentials webinar series. And there'll be one every week for the next 4 weeks, and then we'll have a little break for a week or so, and then we'll come on and do some more webinars. So hopefully you can all hear me, and there should be, if you want to type in any messages or type in any questions, please feel free to do so as we go through, and we'll and I will try and answer any ones that come up that are relevant to what we're talking about. I'll try and answer them as we go along, and if there's a large number of them, we'll try and answer them a little bit more as we go through. But we will kick off. So this is the first one. This is Introduction to Forex. Now, what we're trying to get out of this webinar today is really trying to not tell everyone the basics of Forex, which of course we will do. We'll go through some of the basic points of what Forex is and how you trade it and how you would use it. But also we're going to try and talk about some of those more taboo subjects that people don't necessarily, that a lot of brokers don't always necessarily talk about when it comes to trading. But for us as traders, that it's probably the most they're the one things that we want to talk about. And once we do have accounts opening, and once we do start running with our trading lives, they're the things that people want to know a little bit more about. So like things like requotes, things like slippage, those big things that often cost us a little bit of money, but I mean, we always tend to want to blame someone about, but they of course happen to everyone. So we'll talk about a few of those things as well. I'm going to have the MetaTrader platform up on there, and for those of you who aren't necessarily that familiar with the platform, don't worry, there's not going to be anything too complicated in there. We're just going to be running along and basically touch on a few points in it. In a couple of weeks' time, the webinar after that is about MT4, so we'll have a much more in-depth run through about how it works and what we're looking at and things like that. So, but we'll kick off. There's one thing I always like to start off with when I start these seminars and these webinars, and we talk to people about Forex and trading, and that is that there's one thing that every one of us has in common, whether it be myself as an analyst or any of the analysts here at Alpari, or the trading desk at Alpari, or a trading desk anywhere around the world, or even when it comes to you guys as retail traders, presidents of banks and Bob Diamonds and anyone like that, the one thing that everyone has in common is that not one of us has any idea at all where the market's going to go. Not a clue. None of us. So what we do is we use the tools at our disposal and the tools on our trading platforms and the commentary that our analysts will send and whoever it may be in the websites that we look at, and we'll try and make the best informed trading decisions that we can. And I think it's important to understand that when you do trade, you're not going to be right all the time. And again, one of those taboo subjects that people don't necessarily talk about when you talk about brokers is that you will lose money. At one point, when you trade, you're not going to be successful. You will lose some money. No one does 100 trades and wins every single one of them. At one point, you will lose money. And trading is all about reactions. Not necessarily reacting to the markets, not necessarily reacting to your MACDs or your moving averages or your support and resistance lines. Of course, that's important, but that's not the biggest reaction you need to look at. The biggest reaction and the most important reaction is how you react to losing money, and that is the biggest one. I think a lot of people, when you first start out in this, a lot of people start by opening accounts and saying, okay, I'm going to put, say, $200 in my trading account. So here's my $200. It's in my trading account, but I want that $200. That $200 is important to me. Now, when you put it in a trading account and to be successful with it, you need to almost consider that $200 as gone, as it's not money that you need. You've put it in this trading account and it's gone. So you don't become too attached to it. Now, we always become attached to it, and there's the emotional side of trading, which is an absolutely huge subject that we will touch on for a part of this, but of course is a massive subject in terms of psychology and how you approach it, and you can really, your mind can go crazy on a few of these things if you overcomplicate things. But the emotional side of trading is massive, and I think what you get when you trade is that a lot of people and a lot of brokers, and we will do the same thing at our Pari, we'll tell you to if you want to get used to things, obviously open up a demo account. Opening a demo account is the key thing. All the brokers offer them. So you go in and you open up a demo account. And demo accounts are fantastic. They're fantastic for learning the software. It's hard enough to trade Forex or trade whatever it is you're trading and make money without making silly mistakes on the trading platform that you have. Now, the one area I don't feel that it's necessarily that good for is what a lot of people use it for is to test out trading strategies. And the reason I don't find it that useful is because if you open an account, a demo account with our Pari, and they maybe give you £50,000 or £500,000 in your demo account. Now, realistically, none of us are going to have £500,000, £50,000 in our account. Now, of course, there will be some of them. My account definitely hasn't got anywhere near that much money in it. And it doesn't make you trade the way you would do as if it was your own $200 or $300 or $1,000. It doesn't make you trade that way. It makes you trade differently. It makes you not think about making or losing money. And then people will say, of course, well, okay, I've got £500,000 in the account, but I don't necessarily want to. I don't use all that money in my positions. It doesn't necessarily matter, because every time you trade, in the back of your mind, even if you're trying to be as strict as anything, you will always think to yourself in the back of your mind that this is not my money. It doesn't necessarily matter as much. And as soon as you come to placing your trade on your own money, on a real account, you will find you take 10 times longer to place a trade than you would do on the demo account. So say, for argument's sake here, we've got this euro-dollar chart up here. And this is just a basic example. So yesterday, myself and Craig's the other analyst that we have, another one of the analysts we have here at our Pari, we were looking at these, and we look at the two moving averages on here with 10 periods and 20 periods, and 10-20 moving average. We look for that cross. Now, I did it on a live account. Craig did it on a test account. Craig had done it about 10 minutes before I'd done it. And he was making money before I made money at all. Mine was a live account, and it was only about 50p a point. I think I ended up trading as well. But it just makes you think a lot harder and think a lot more about trading when it's your own money, even if it's not a massive amount that you're trading. If you're doing it on a demo account, you'll do it as quick as anything. And it just is that mindset. You may not think about doing it, but it's in the back of your mind all the time. So there's a few important bits there that we go over, but we'll talk a little bit about the webinar is called Introduction to Forex, so we'll talk about Forex a little bit here. Of course, Forex markets have become massively popular in the world of retail trading these days, and I think the reason for that is mainly the volatility. The volatility is what we get, and a lot of people sometimes get scared about volatility and get scared about what we see happening and what moves and how fast the market can move. But I don't necessarily, but that can't always be seen as a problem. Okay, it's a problem if you're in a trade and the market's moving and you're losing money against it, and your position's a little bit too big. But volatility is a positive thing when it comes to trading. As traders, it's something we want. In a market of sideways movement with not necessarily too much in the way of volatility, we don't get trading opportunities. We don't get buy and sell entry levels, and that's what volatility does for us. It gives us those things. It enables us to make our trading decisions, and that's all we want. That's all we want to be able to do, really, at the end of it. So I think the volatility side is not something that should scare you. It should be something that you embrace, and of course that's why Forex has become so popular over the last sort of, I'd say, 5 to 6 years. It's become a lot more popular in the world of retail trading. And what a lot of people don't realize, as a retail trader, a lot of us tend to think that we're not important in these markets. But we're massively important. Retail traders are hugely important these days. And we sometimes think that we're not the big banks, or I'm not trading through Goldman Sachs. I'm only doing, maybe I've got an our Pari spread bet account, and I'm only doing £1 per point or £2 per point on my trading, so it doesn't necessarily matter that much. And that's not true. The world of retail trading is taking over in a way. It's when you look at the likes of, going back to stocks for a little while, but when you look at the likes of the FTSE 100 the trades that go through the London Stock Exchange, there's a very high percentage of those trades that go through that are generated by CFDs, and they are done through a lot of retail brokers. Now, retail brokers have to clear with someone else. They go through the big banks. They go through these big people. But retail traders have a huge say in the market. They have a huge say in where these markets go. Now, a lot of the days now with Forex, you have these direct market access, no dealing desk accounts, where your trades go directly to the big banks. And of course, there's no central location for Forex, but your trades go directly to the banks. They go to Goldman's, they go to Deutsche, they go to whoever it is your broker's using, and they affect the markets. Now, of course, that's not saying that a £1 per point trade on euro dollar is going to move the euro dollar sort of 10 pips, but it's saying that these trades are important. And of course, when you've got so many people doing it around the world, and retail traders are of course blossom around the world at the moment, it's been such a booming industry that if these trades are big enough and the amount of people that trade on them are big enough, then of course you do get it does have an influence on the markets. And you look towards the platforms, and you look at what you get in terms of money. Now, all throughout your broker, our par, we probably have, I don't know, 10 Bloomberg terminals, and a couple of Reuters terminals as well. Now, and we probably pay, I don't know, anywhere between sort of $1,000 and $3,000 a month for these platforms. But what retail brokers offer you these days is these platforms which have amazing charts, have amazing pricing, have all the tools you can imagine, all the news feeds you can imagine from the team of analysts that they have there, direct market access. The best platforms you can get out there are these platforms from retail brokers. Now, of course, talking about our pari, we have MT4, and of course it's the most popular Forex trading platform in the world. And the reason for that is because it is so good. People do like the reliability of it, the charts, and people will think, oh, I want a Bloomberg because it's what everyone else has. The Bloomberg is great if you don't want to trade on it, because it's the one things that they don't let you trade through. So the best platforms you get out there are the retail platforms, because they give you all the news, all the charts, and all the background that a Bloomberg or a Reuters give you. But they also give you the ability to trade, and that's the key thing. That's a really important part of this. This is the way we want these things to run. So it's important to have that. I think it's important to make sure you realize that as a retail trader, you're not insignificant in the market. And okay, your Forex market is massive, and a way to highlight that, of course, is the amount of and these numbers may be a little bit old, but the number of trades that go through the London Stock Exchange. The daily volume of trades that go through the London Stock Exchange is in the region of $7 billion. $7 billion every day through the London Stock Exchange. Now, the daily volume on the Forex market is around $4 trillion a day. So it's absolutely massive. $4 trillion worth of trading goes through that Forex market today. So you can see, number one, the popularity. You can see why it is so why it's so popular, and you can see why the market's why the volatility is there, and that's exactly what we all want. So going back into exactly what Forex is, and we'll cover the basics. So I apologize if you know already about Forex or know a little bit, but of course this is an introduction to Forex webinar. So we've got, obviously, Forex is trading on currencies. It is trading on currencies. It's buying it's the simultaneously buying of one currency and selling of the other. And the simplest way to explain it, of course, is to explain it as if you were traveling on holiday abroad. So, of course, all in this top left-hand corner of the MetaTrader platform, we have all the currency pairs that we offer there. So there's a number of different currency pairs. Everything you can think of is in there. But the way to explain it is that, of course, you go on holiday. So you're going to the US. You will look to see what the rate between pounds and US dollars are, because you need to use US dollars when you go away. So when you go away and you place that, you go to your TravelX or whoever it may be, Thomas Cook, whoever it is, other currency exchanges are available. You get the option to change your money up, and that is theoretically a Forex trade. You're trading on the Forex markets, because of course whoever it may be you're doing that with will hedge their bets in sort of underlying markets. So when you do that, you are trading on the Forex market. Now what Forex trading is basically a way to do that, but without taking the physical cash out of it. Now, of course, we've got up here, we've got the euro dollar, and let me just get an order ticket open there for you. When you go to a travel agent on the high street and look to change your money, you don't get anywhere near the rates that you get here, of course, and that would be the one thing that a lot of people notice. And when you start Forex trading, it's the one thing that you always notice, how much you get ripped off on the high street when you go on holiday. So you've got, for argument's sake here, we've got the euro dollar price of 128.62, and we've got obviously a minute spread in that. Now, if you were going on the going to the travel agent, they'll probably sell you 121 and buy you 150. So there'd be crazily wider spread, and it would be unbelievable. But of course, from this point of view, when you do that change up at a travel agent, you are theoretically trading on Forex. So when you come to do it here, it's no different necessarily. You sell one and you buy the other, and it's a lot of people find Forex complicated, and a lot of people find trading complicated. And then when you start to talk about Forex, people think it's that little bit more complicated, just because of you hear things about rollovers and different overnight charges and here and there, things being different all over the place. But when you break it down to its basics, you are still trading on the market, and theoretically you're doing exactly the same thing as what you would be doing on indices or on commodities. It's exactly the same thing. You're doing 100% the same trade. And if I were to not tell you that was euro dollar and you couldn't see anything here, and you just looked at that chart, you couldn't, and there was no numbers on it, they all look the same. Whether it's the Dow Jones, the euro dollar, the, I don't know, Vodafone or whoever, whatever the chart may be, it doesn't matter. All the charts look the same. They're either going up, down, or sideways. Okay, so they're all doing exactly the same sort of thing. So it doesn't matter what it is that you're trading on, especially if you're a technical analyst. And I don't want to jump ahead of things and start talking TA before we've got anywhere about anything else. But technical analysis is the study of charts to make yourself trade, to give you those indications of when to buy and when to sell. So the charts are all the same. There's no need to overcomplicate these things. They'll go up, down, or sideways, and that's all you need to remember. Now, you put all the prices back on it, and you stick an order ticket back in there, and you see it goes to 5 decimal places, and it all gets a bit too complicated, and you say, oh, it's very volatile, and I'm a little bit scared of it. Yeah, of course, these things, anything that's a little bit more volatile will, of course, has the ability to make you more money, yes, but also has the ability to make you lose more money because of the volatility there. But there are things in place on every broker, not just Alpari, on all brokers. There will be risk management tools, stop losses, and you'll hear everyone, any seminar you go to, and if you go to the trade shows or anything like that, you will hear people talk about risk management in every single seminar that you'll watch. There will be a section in risk management and talking about stop losses when you trade. Stop losses are the single most important thing about trading. Now, that doesn't mean you always have to place one. It doesn't mean you always have to place one. Sometimes if you're able and you're in a luxury position to be in front of your screen all the time when you trade, you don't always have to place one because you're there to react. But of course, if you're taking a longer term view, and as long as you're always thinking about potentially putting a stop loss in place, because that will protect you against the market going against you. But we've jumped ahead a little bit, and let's take a step back. So trading, Forex trading, is pretty much that. Is simultaneously buying of one currency and the selling of another. So that is very, very simple. Now, and it is the same as when you go on holiday, you trade your money, you change your money up, and that is a Forex trade. What we do is we give you a platform to do it on a larger scale, if you want it to be, or on a smaller scale, but in a much more fast-paced environment. And the luxury of Forex trading for the retail trader these days is the ability to do it in and out as quickly as you can. So if I wanted to now, I could sell that euro dollar or buy it, and then I could instantly close my position straight away and realize some profit or realize some loss. Of course, with Forex as well, the spreads are very tight, so that's another good thing for the markets, because you can always make sure that, sorry, not for the markets, for when you trade, because you don't have to have that big wait until you can become profitable in your trades, and that's of course something that everyone's looking for. So going back to the basics of it, you can see there that on this euro dollar we have two prices, 128.59 and 4, of course, is the point. So we have a pip and a point. So if you get you a little bit more confused, the pip is the fourth decimal place, and then we have the point, which is the smaller one. Okay, so the price here, 128.60 is the pip, and then 2 is the last one, and that's your sell price. And that's either called your sell price or your bid price. And you always have prices quoted in twos. So you have the sell price and the buy price, or often known as the bid price and the quote price. The sell price is always called sell or bid or bid. The offer price or the quote price or the buy price has got different names, as I've just said them all. So bid and offer, or bid and quote, bid and ask, or just sell and buy. Sell and buy is always the easiest way to go with it. So it's a very simple, and the platforms give you it spelled out. So sell the market and buy the market. And you can see where it says here sell by market and buy by market. So this is what sometimes, obviously I work at Alpari and I'm a chief market analyst here, but there are things about all platforms, and I used to work at CMC Markets, and there was things about that platform that annoyed the hell out of me as well, and there's things about every platform that can be annoying, and they can almost confuse you a little bit. So for the new trader coming on and seeing this, you look to trade, and what you see is sell by market. Now you don't need that sell by market. The buy bit tends to confuse you. The market side means market execution at the current market price. And when we say at the current market price, we mean the price that is currently showing there. So when it says sell by market, it can be very confusing. You don't need it to say that. It just needs to say sell or buy. That's the only thing you need to worry about when it comes to that. So the price will always be there. Now, this is where we come to something that can be a little bit more of a touchy subject that people don't always like talking about, which is the requote side. Now, what happens when you trade is you can be requoted. Now, what that requote usually means is it means that the price has moved as you've placed the trade. So, and this is where I always try and place a trade and hopefully get requoted, and I never am. So, we'll place a trade here. So I'm just going to buy euro dollar, just a very random trade. So we're going to buy it. So we go to the buy price, 128.60. We click buy. Now it just waits for our order, and straight away we've got the price done. Now if you were requoted, it would give you a different price on here. It would show you another price. Now requotes are a very touchy subject because people think a lot of the times that it's brokers who are purposely requoting people, purposely making it out to make your trade not be profitable or not work in your favor. Requotes are not something which is special to Alpari or special to CMC Markets or IG or whoever, any other broker that you want to trade with. Requotes happen everywhere, absolutely everywhere, and there's nothing that can ever be done about them. You will be requoted when you trade. It's a fact. Now, what you get is quite a lot of people tend to get themselves a bit caught up about requotes, and don't get me wrong, they can be extremely frustrating. You're trying to get into the market, you want to get in the market, and you know the price you want to get in at, but as soon as you place it, you hit a requote, and you can't get in as quickly as you want, and you can't get in as at the right price that you want, and that, of course, is always frustrating. But it's not something that's done by the dealing desk with the broker that you work with. It's just something that happens because the market moves so quickly. So you will go to place your trade, and it has moved away from the price that you're looking to trade at. And if that moves away, then of course the broker can't give you the price that you've gone for. So let's go back to this order ticket for a second. Let's open that again. So say I wanted to buy, the price currently 128.58.5, 128.58.5. Now if that moves from 58.5 to 58.4, and you can see how quickly it's moving, as I've pressed buy, we can't give you that price because it's not the price anymore. Between that split second between you hitting buy and us getting the trade going through, the price changes. You can see how quickly these things change. So you will be requoted. That is how these things work, because the price is just no longer there. It's not the broker's fault. It's not your fault. It's just something that happens in the market. And don't get me wrong, it can be unbelievably frustrating, but it's just one of these things that happens, and we can't necessarily do too much about it. Of course, we always want to get in times when the market's volatile. That's one of the things that we want to talk about. That's one of the things that we always try and do. We want to get in the market when it's moving, when it's it's volatile, when the markets are busy, and we want to get in times when there are more trading opportunities. That tends to be times when it's volatile. That tends to be times when more requotes happen. It's just the way of the world, unfortunately. So okay, so we'll move on a little bit from requotes, and if anyone's got any questions, then by all means ask them and get them through. So I do have a question here. Let me just read it. There's people asking actually, why are my spreads on my my platform better than the ones you've got? I'll tell you exactly why that is because I can't make any money on my platform because it's an internal one. That is exactly the reason. So my spreads aren't necessarily proper spreads. So that would be exactly the reason that is. I wish I could have this account and place trades on it as well, because I'd also get the £550,000 that's in the account as well, but I can't. Okay, so we'll move on a little bit. So we've covered the fact that Forex is very there is basic forms of doing it, and we've covered the mechanics of how you trade. Now there's also a point to cover on this, which is how you trade. Now one of the big questions that we get when we do seminars and we go to the trade shows, or whenever we speak to clients, is everyone wants to know what trading strategy I should do. How should I trade? How do I make money? And that is obviously a natural thing. We all want to know the best way to basically become millionaires out of this. Now, I think one important point to say here is that a lot of brokers and a lot of places will sell you a dream of becoming a multi-millionaire by the end of your first trading week. Now, that's not going to happen. You could become a millionaire at the end of your first trading week and have £1 million in your trading account. And you could do that if at the start of the week you deposited £900,000 into your account. There is a potential that if you deposited £900,000, you could make £100,000 in a week. But you need to be able to have put that money down. You don't, within Forex, you don't come in and put £200 in your account and come out at the end of the week with $1 million. It's not a get-rich-quick scheme. It is not the way it's not how it's sold. It's not how you trade. And there needs to be an honesty in terms of a lot of this, because sometimes you do get times when people do think that this is a very easy way to make money, and it can be a very easy way to make money. It can be a very profitable thing to do. But an important thing to remember is not only are these things very volatile, and that's great when you're making money and trading and you're in a positive position, but of course the markets go against you, and that's why we've already spoke about risk management and stops, because I mean they are some of the most important things to do, because they will protect you from going down. I mean, one of the other points that we need to cover over is margin and leverage trading, and that's why a lot of retail trading gets a bad name. It can be seen as something where you can trade without necessarily having that amount of money in your account. Of course, leverage is an amazing thing, because it basically allows you to take on a bigger position than what you would necessarily take on, which is of course fantastic. Just to answer a quick question here. Someone said, "Is this webinar recorded?" Yes, it is recorded, and it will go onto that Trading Essentials page. So by all means, you can catch it afterwards as well as now. Okay, so margin and leverage, that's what I was talking about. Okay, so the leverage side of things. So margin is fantastic. What it enables you to do is take on a position larger than what you would normally be able to take on. Now, the general rule of thumb and this is not talking necessarily our pari, this is talking other things as well, other brokers as well. The general rule of thumb is a lot of the time you get almost sort of 1% margin requirements. So your overall position value could be huge, and could be a massive value of say $1 million or so, but the general rule of thumb is that you only have to put up 1% of that. And now that is a huge trading tool, because when you think about going back to trading, say the old times of just trading stocks, when the only thing you could trade as Mr. Joe Public was stocks. Say I wanted to buy some Vodafone shares. My Vodafone shares, I'd say I've got £5,000 to invest in Vodafone shares. Okay, that's fantastic. You want to invest that, and I know that my £5,000 will increase or decrease in value. Okay, so that's Very simple, but it doesn't give you much leeway, because I know if I give my £5,000 to my stockbroker. That stockbroker says, okay, you've bought £5,000 at £5,000 worth of Vodafone shares, however many shares that would be at that current price. Now I know that my value of my investment is £5,000, and the worst that can happen is that that price will go from whatever it was, say for argument's sake it was 100 pence, it could go from 100 to 0. And I know the most amount of money that I could lose when I trade is that £5,000, because if my investment's worth £5,000 at 100 pence, at 0 pence, it's worth nothing. Okay, so that is a very simple way to think about how you used to be able to trade. Now with margin and leverage trading, what it enables you to do is say, okay, I want a £5,000 investment, but I only want to put up £50 as a deposit down. And that's what margin and leverage trading can do. Now, of course, the biggest issue with that, and it's a fantastic tool, okay, so the tool is you can take on positions that are bigger than the account, the money you have in your account. So you've got $200 in your account, you can take on 500 to 1's leverage on the back of that. So, okay, so I've taken out my position, and it's much bigger than the money in my account. And the biggest and most positive thing behind that is that if the market goes my way, my profits are going to be magnified. My profits will be magnified and will become, and if the market goes my way, I will make more money than what I would have done if I only invested £200. Now, the flip side of that is that, of course, in our other example, £5,000 was the most amount of money we could lose. In this case, of course, we're only putting up, say, if we're looking at the same examples, we're only putting up £50, but the most we can lose is £5,000. So your initial deposit is not the most amount of money you can lose, and that's the biggest thing. The one line about margin and leverage trading, which is the most important one, is that margin is a great tool. It can greatly increase the profitability of your trades, but it can also magnify your losses. And that is a key point. You must make sure that you always remember that. And there's an example that I tend to give quite a lot of the time. So if you've ever been to one of my seminars before, I apologize. But we used to have a guy, a different company that I worked at, a guy that traded on the FTSE 100. He traded on the FTSE 100, and he used margin to do so. So what he did was he took on a position, which I think he had a fairly average account for the size. So everything is about £3,000 account. So not huge, but not small. And he traded, and he had a big took on a big position. So he took on what could have been around £100 a point, or whatever it was at the time. Now what he did was, his trading strategy, which I would not advise in the slightest, is that at the end of the week, if he was in positive territory, he doubled his position. So he looked at his position, and he was in positive, so he doubled it. Fantastic, that's great if you're still going up. So at the end of the next week, kept doing it. Again, checked it, and he doubled it, and he kept making money and making money and making money. Now, he happened to pick a fairly positive time in the markets, and after 6 months of trading, his £3,000 account had gone to £500,000. Okay, all on the back of trading margin, because he didn't have a position, he didn't have enough money in his account. £3,000 in his account is nowhere near enough to take out a big position like that if you were trading in the old times, but if you're trading on margin, it allows you to do that. So he took that position, and he was making, by the end of 6 months, £500,000. So he's up enormous amounts of money on just the £3,000 account he had. Now what he'd done though is he gave the market absolutely no room for leeway. He gave it no room whatsoever. And what happened at the end of the 6 months is that the market aggressively went against him. So it went against him in a big way. And what happened was that he ended up, by the end of that 3-week period, now considering after 6 months his account's gone up £497,000, at the end of a 3-week period he ended up owing the company that I worked for £3,000. So you can see, by over leveraging and not giving the market any leeway whatsoever, you can take on a position that is far too big for the amount of money that you can have in your account. Now, okay, your broker will let you do it, and you do have enough money in your account to cover it, but what you always need to remember is you always need to remember that the market will go down as well as up. So if you're long of the market, it's not just going to go from the second you buy it. It's not just going to go you buy here and then ramp it straight up in one big long trend until you close it. It doesn't happen that way. The market will do exactly what this euro dollar price is doing here, and it will fluctuate all over the place. And if you see how often this does this, look, we will have the market doing this all the time. It won't go up and go down. And if you can see the long-term trade, if you'd shorted this, then long-term overall you would be in positive territory. If you sold here, bought it back here, you'd be in positive territory. But in the whole of the life of this trade, it would be a roller coaster. Big swings up, big swings down. And if you over margin, if you over leverage your account, take on far too much margin than what you do have in there, then you will not have enough money to allow the market to go against you. And of course the market will always go against you at some point. And that's a really important part of this. We always need to make sure that you are protected from the market market going against you. It's a key point. Now, one way to do that, of course, and what this guy in that example could have done and should have done, is something that we spoke about earlier, and is placing stop losses. Now, stop losses are a very key part of trading. You always have to make sure that you are looking at placing stop losses. And again, like I said before, not necessarily placing them, but making sure you're looking to place them, and always considering placing a stop loss. Anyway, we have really pushed on and sort of gone off at a tangent, which I knew would happen. So I apologise that we've done that. But let's we'll come back to a little bit more of the basics if you haven't necessarily dealt with them before. So we'll go to another chart. So let's have a look at this cable. We'll have a look at cable here. Sorry, I don't like it when they're black and green. Whoever decided that was a good colour scheme, I will never know. Black and white is fine. There we go. Okay, and we'll have candles. Okay, so I mean, the next point that we need that we're going to look at is just some of the basics around sort of bullish and bearish trading. Now, you'll hear a lot of people talk about bullish and bearish trading quite a lot of the times, and it's something within Forex trading that gets new people into the subject a little bit confused is all the jargon. Now, jargon is a bit of a pain, to be perfectly honest, because as we've already seen with the likes of the bid and ask price, or the bid offer price, or the bid and quote price, or the buy and sell price, they all mean the same thing, but we've got so many different names for them. So knowing a bit of the jargon is key. So we've covered off requotes and what that means. It just means the market moves against you and you get a different price. Some of the other bits of jargon we'll cover off. One of them is this bullish and bearish side. Now, it may sound like a basic one to a lot of people, and I apologise, but it is a very important part, because if you don't know what bullish and bearish stands for, then it's something that can get you a little bit confused. Now, of course, bullish is when people think the market is going up. They think they are bullish on something. They mean it's a positive thing. Now, you always hear these bulls and bears in the markets. Now, there is actually a reason behind it. So there is a reason behind it, and it's not just some random Wall Street guy decided to come up with it. The bull, the reason we call it bullish, and the reason that it's a reference to a bull, is it's all about how these different animals attack. And people think when you say bullish and bearish that it's nothing to do with animals. It is to do with the animals. It is to do with the bull, and it is to do with the bear. Now, and it all comes down to how you would be attacked by one of these. And I don't know if any of you have ever been attacked by a bull or a bear, but if you had been, and I haven't necessarily, but there is a way that supposedly they attack. So if you're bullish, it means that you think the market's going up, and that's because it's called bullish, because when a bull attacks you, it will point its horns up and move in an upward momentum. So if it comes to attack you, a bull, if you're ever going to be attacked by a bull, you will notice that it will stick its horns low and then move up with them. Okay, so there's your bullish. And bearish is the other way. So if you ever become attacked by a bear, God forbid, you will have a bear standing over you, and it will strike down with its paws. So that is where it comes from. So anyone who's talking about being bearish means they are more negative of the market. They think the market's going to go down, and that means from the bear hitting down on you. So that's where those two points come from, and people tend to think of it as a load of rubbish, but it's not necessarily. That is actually where they come from. Another bit of jargon that people talk about, and it's we have the pound versus the US dollar chart up here. Now, it's also called cable. Okay, now it's called cable, and again, this is one of those people think it's necessarily an old wives' tale, and it may be, but this is the one I've always believed. But the reason it's called cable is because of the old transatlantic cables that used to run between the US and the UK. Under the Atlantic Ocean, there used to just be a cable that connected the two, and that's why it's called cable. So again, a really basic reason, and we try and overcomplicate a lot of these things, but it doesn't always come that way. So there's a couple of bits of jargon that we were talking about. So one other point I want to look into just before we finish off, and then if there's any more questions, then please send them through now, and I'll try and answer them at the end. But another one of the interesting points that we come to is these trading strategies. I touched on it earlier, and how you go about deciding what to do and when to do it. Now, again, we're not all in the luxury position of being able to sit in front of our screens all day long and trade and always look at the market. So again, we spoke about stop losses and limit orders when doing that. So there's two major strategies when it comes to trading. One of those would be day trading, and one of those would be trend following. Okay, so day trading, again, very basic, and as it does basically what it says. Day trading is when you're in and out of the market on a daily basis. So you buy and you sell, but you never hold a position overnight. Now you can, of course, through forms of trading, through retail trading and trading with our pari or whoever it may be, you can hold your positions for as long as you like. But one of those charges that isn't, a lot of brokers will come out and say, well, it's totally free to trade all the time. Now, one of those charges, which gets hidden quite a lot of the time, is the overnight financing charges or rollover charges. If you decide to hold a position overnight, so say you bought, say for argument's sake, we go in euro dollar, and I forgot to open that position earlier. Let's do something else. Let's look at cable. Okay, so I go in and I buy cable. So I've bought that, and that's now a running position. Now I can decide to close that whenever I want to. But if I don't close it by the end of the trading day today, so if I haven't closed it by midnight and roll it into the next day, I'll be charged a rollover charge. And basically what that is we spoke about margin and leverage, and we spoke about how margin and leverage is basically a way that your broker is lending you money to have this trade. Okay, it's a very simple way to think about it. You're only putting up $200 for your trade. Your overall value of your position is $200,000. Theoretically, your broker is lending you the money. So you get charged a rollover rate, a financing rate overnight to hold that position. Okay, so if you're going to trade overnight and hold it overnight, which a lot of people do, and we'll come to that a little bit more when we talk about trend following in a second, but you are charged a rollover time, charged a rollover financing rate. Now, people get away from that by day trading during the day in and out of the market. Okay, buying at one point, selling it 10 minutes, an hour, 2 hours later. Again, of course, not only buying, selling as well. So in and out of the market all the time. Now that works very well when there's times of volatility, and of course, going back to why we all trade Forex, that is why we look to trade Forex, because of the volatility in the markets, and it's ideal for day trading. Okay, so it's a key way people tend to trade in and out of the market all the time. Now, all of these markets are open 24/7, so, well, 24/5, not open at the weekends, but the way they trade, and it's important to remember that if you are a day trader, to make sure your positions are closed. The last thing you want to do is have a number of different positions open, and I've seen this happen a number of times, I've even done it myself, where you go in, you open a number of different positions, and then by the time you come out of the market or you close down your terminal, you've got a position left open that you didn't know about. You wake up in the morning, you log in, and you're $3,000 down on the back of something you didn't know. These markets move all the time. Even when you're asleep, they are not asleep. So it's important to always remember to close down. Now, and we spoke about day trading a second ago and said at the end of your trading day, make sure you're out of your positions. And people will ask, well, when is the end of the trading day? The end of the trading day is whenever you want it to be the end of the trading day, whenever you don't want to trade anymore. So say, for argument's sake, you trade every day, you trade from 9 a.m. till 11 a.m., or you trade from, say, 6 a.m. to 8:30 a.m. when you go to work. That is your trading day. Okay, so and this is the whole point about Forex and retail traders and retail trading. You have flexibility to do whatever you want whenever you want to do it. And of course, the good thing about Forex, which it doesn't happen with stock markets, is that it doesn't open and close. The only time you can't trade is at the weekend. So if we say come out of your positions by the end of your trading day, that means whenever you want it to be the end of your trading day. You're not stuck down to what anyone else says is the trading day. You can do it whenever you want to. Okay, so the other form of trading is this more trend-following trade. Now, there's an old adage, and I'm trying to find something that is in a trend and has been for quite a long time without looking at gold, because gold's always the more obvious one. Let's try and look at something. Dollar Swiss may be one of those if we go in a more longer-term period. Bear with me a second. There we go. So you've got quite a long-term, well, it looks like a long-term trade, but it's actually quite a short time period. Let's change that background again. No one likes black on green. Okay, so let's zoom this all the way out and let's go on a daily chart. So there we go. So it's a fairly, you can see here, it's a fairly long-term trade trend from 2009 to here at the lows in July 2011. Now that's a long-term trade. Now there's an old adage that says the trend is your friend. Now that also is extended to the trend is your friend apart from the bend at the end. Now the trend is your friend basically means that you can trade. The trend following is one of the most basic forms of trading and is a very simple way to make money. And the way it does it, it basically says that if something is in a trend, so this is in a downward trend, meaning the market's been going down for a long period of time, you just follow the momentum. Okay, so you in this case you would sell into this and just follow that on its way down. Okay, the trend is your friend, meaning follow it, get on the bandwagon with everyone else. If this is going down, the worst thing that you can do is try and pick the bottom of the market. If you try and pick the bottom of the market, 9 times out of 10, you will not succeed and you will lose money straight away. So and that's an important point. You have to always, the market is weak in this case for a reason. Okay, and not just because you want to trade £2 per point on dollar Swiss means that it's going to turn around. That doesn't happen. It's weak because there are fundamental reasons behind it that tell you it's weak. So it's an important point to go with, that's the case. So always remember that you can't necessarily ever pick a bottom. Now every now and again there will be a few people down here that pick that very bottom point of that trade and when they're unable to run it higher. They are very, very lucky indeed, or have insider knowledge, in which case they go to prison for a long time. So it's not something that happens all the time. And this is the point where you say trend is your friend apart from the bend at the end. So the trend is your friend if you sell here and you run all the way down, but that little turn as the market turns around is the bit that's not your friend. But trend following is different to day trading. Day trading is short term in and out of the market, whereas trend following trading is longer term. You buy in or you sell into the market and you're looking to run this momentum. So you're looking to run that lower or run it higher in a different terms if the market's going the other way. So again, a way that you can always make sure that you're doing the right thing, and day trading is one of those that people tend to do when they're a little bit more experienced into it, because it is more fast-paced. It is for you if you can trade and be in front of your screen a lot of the time, because you can take your positions and monitor things, because you need to be able to monitor them if you're in it on a day-to-day basis, jumping around and moving all over the place. So again, it's an important thing to remember. So basically, the market, if you're doing trend following, you will just look to buy in or sell into the market and run it lower. And of course, these trends can run for a long period of time, so you are going to get charged a financing rate if you're holding them overnight. But however you think about it, you think that the trend is longer term, your position's on, you think you're going to make more money. Of course, you'll make more money than, if you're right, you'll make more money than what your financing costs are. Of course, they're very minimal charges. So you will end up following it and being but the issue is that these trends can last for a long time. Trend can last for anything from a day to 5 years, 10 years, 20 years. I mean, you look at the likes of gold. Gold's basically been an uptrend for forever. So so these things can last a long time. The issue is, and again, as we covered earlier on, is this point of if the market is rebounding and bouncing all over the place, it's not always going to solidly go down all the time. In this case, of course, the market did go down, but it did bounce around all over the place. So again, it's important to remember that you have to not margin yourself up to the eyeballs. If you margin yourself up to the eyeballs and have no leeway for the market to go against you, then it's gonna affect you, and it's gonna end up, if the market does go against you, you're going to get liquidated. Your positions will get closed out, and you won't have positions or money left in your account. So it's a key thing to remember. Don't over leverage yourself on the markets. Okay, so we've been going for almost an hour now. I just want to look at a couple of your questions. If anyone's got any more questions, then please send them in. And someone's asked me about, I'll go back to my euro-dollar trade, someone's asked me about my moving averages, the moving average values on there. Now, we spoke about these earlier. This is a key trading strategy, actually, one that tends to work quite well quite a lot of times. These are basically, if I go to the end of that, we just have a 10 day and 15 day, 10 and 20 day moving, exponential moving average on this this chart. And then, I'll answer that, Mike. I'll answer your question in 2 seconds. I didn't come to slippage yet. I'll answer that in 2 seconds. Okay, so there's looking at these moving averages. I have a 10 period and 20 period moving average on a 15-minute chart. And what we're looking for is the crosses, and the crosses do tend to happen quite a lot of the time. They're important. When they cross, you tend to have it followed by these big moves. So we had a cross here, big move higher, cross here, big move lower, and then we're still in that one, to be perfectly honest. So that's quite a long-term one. So it's a very simple strategy. You see these crosses on a daily basis on this, and they're very simple ones. Now, of course, they do also go against you. They don't always make money by any stretch of the imagination. So having stop losses in place is a key point on that, and this is a very much a day trader technique here. But and if you're going to come to any more of the seminars, of course we've got webinars. Sorry, the one in 3 weeks' time, and I'll load the web page up before we finish. Is Introduction to Technical Analysis, and we'll talk a little bit more about moving averages and things like that. Okay, so Mike, you asked, is slippage the same as a requote? No, slippage is not the same as a requote. Slippage is different, and I'll talk to you about slippage now. I said I would do that. Sorry, and I forgot to mention it. Slippage happens on a stop loss, basically, and when it happens, it's one of those points. So say for argument's sake, let's get this. We'll annotate this on a chart. So please ignore the buy point down there. I'm just going to add a few lines. So here's the lines, horizontal line here. So say for argument's sake, your stop loss is at this point here. Okay, so your stop loss is at 120.29.10. 121.10.9. Okay, so your stop loss is here. So let's scroll this back a little bit. Okay, so the market has done this. This is your stop loss in this level here, and the market is falling, and it's falling very aggressively. Okay, so what slippage is a slippage happens on your stop loss. So you'll hear a lot of people say my stop got slipped, and what it means is that your stop loss in this example that we've got here is at 129.10. Now, if your stop loss is at 129.10 and it gets slipped, it means that your stop wasn't filled at the price that you wanted it to be filled. So you wanted it to be filled at 129.10, and for argument's sake, let's put another line in. It got filled at, so for argument's sake, it got filled at 129.03. Okay, so it didn't get filled here, it got filled here. Now the reason for that would be, the reason we call it slippage is because the market never trades at that point. That's the reason that you don't get your trade. The market gaps through it. Now and again, this is very much the same as requotes. It's not our pari issue. It's not any of your individual broker issues. It is something that happens when you trade. Happens to everyone that trades. Every now and again, your stop will get slipped because the markets move so quickly. Your stop, it will gap through your price. So no broker can fill your stop if it has gapped through the price. If it never trades at that price, you can't get filled at that price. You get filled at the closest trading price to that point. So again, it's a very important point to remember that these things happen. And again, very much the same as requotes. It is unbelievably annoying when it happens. and of course you wanted your stop at a certain place, and usually stops are of course stopping you from losing money. So if it gaps through, it means you lose a little bit more money than what you expected to. But it is one of those things that happens in trading. It's one of those things you can't necessarily do anything about. If it gaps through that price, it gaps through the price, and you can't go in and trade it. Now, one big issue that happens with this is people look at charts. Now, charts are indicative prices. They're not prices that you can follow every tick on, because the ticks aren't always accurate. Again, not just our pari charts. Every chart, every broker, everywhere will always say the same thing. You have to look at tick data. Look at minute tick data to see if that ever traded at that point. Now, there are times when you'll do it and you'll get slipped, and you'll contest it, and you'll find that it did and it got missed, and that's all well and good. That can happen. 99% of the times, though, these things do happen. So they happen very regularly. So if you get the market does gap, then it's an issue. Then you will get your stop slipped. Now, it happens a lot on Forex because the market moves so quickly. So the market can easily gap sort of 5 points, 10 points. Now, it doesn't often gap sort of 50, 100 points. And a reason it's slightly better on Forex is because the gaps aren't massive, and the times that the gaps can be really big are over the weekends when the market closes. So say, for argument's sake, the market closes. Again, we'll look at the example we have here. So our stop was the market closed at 129.15. Okay, so market closed for the weekend at this point. Okay, over the weekend there was a big election in Greece or something. So the party in Greece came in, and it was the party that decided they didn't want to be in the Eurozone. They fell out of the Eurozone. So on Friday, the value of the euro is 129.10, but over the weekend, Greece have fallen out of the Eurozone. Now, obviously, on Monday morning when the market opens, there is no way that the value of the euro will still be 129.10. As soon as the market opens, the price has to be reevaluated, reweighted, and that's when you get slipped as well. So when the market closes and then there is something happens big over the weekend, it cannot open up at that same price again because there's a huge movement. Okay, something huge has happened, and that's why it's a lot tougher if you say you trade stocks, because when you trade stocks, you have the issue of the market closes every day. So you say used to be a company called Party Gaming. Okay, so online betting firm, and it closed. Well, it was a FTSE 100 company, and it closed 4:30 on a normal day. And at the end of that day, it was worth, say, I don't know, 80 pence. And what happened was, overnight, the US decided that it was going to be law that you could no longer fund an online trading account with a credit card or a debit card. So straight away, the whole of the US, the Party Gaming's US business was completely gone, completely wiped out. So with it closing at 4:30 at 80 pence, overnight, half the company's clients had disappeared. So there's no way that company can still be valued at 80 pence. So when the market reopens again at 8 o'clock the next morning, the movement happens quickly, and it doesn't trade at any of those points. And in that example, the market closed at 80 pence and opened the next morning 7 pence. So that if your stop is anywhere between 80 and 7, you're not going to get filled. Your closest stop price is going to be at 7 pence. You're going to be slipped that much. Again, it's not these things. The big things like that don't happen all the time. Okay, so they are very rare events. But on Forex, it can happen on a daily basis because the market moves so quickly. So I'm just going to have a look at any more of these questions here. So again, someone's asked here, why are you sometimes taken out of the trade before your stop is reached? That doesn't necessarily happen before your stop is reached. It may be the fact that you're looking at the chart, and you'll be obviously looking at the chart and looking at the ticks and how quickly the candles move, and you'll find yourself go out before your chart has actually ticked down to that level. Now that's because, as I said before, the charting is indicative. It's an indicative charting price. So it means that not every tick is highlighted on the chart. And again, not on our pari thing, it's a trading thing. These things, every chart will have every broker will have almost a line, almost a disclaimer on it saying charting is indicative, and that is the case. So it may be a case that has happened, and it will seem like, if you're looking at the chart, that you've been taken out beforehand, but when you check the tick data back, or if you phone the dealing desk, they'll be able to show you a tick data that says that actually you did get taken out at that point. And there's always this misconception that dealers and trading desks want their clients to lose money. That's not true. That is not a true statement. A lot of brokers make money from when their clients trade. So they make money on the spread. So the more you trade, the more the broker will make money, and it's as simple as that. And if a broker was to want its clients to lose money, then of course that would mean that their end goal is that you don't have any money left in your account. But the reality is, if you've got no money in your account, you can't place any trades. The main way we make our money is when you place trades. If you can't place trades, we don't make any money. So it is much better for a broker to have its clients have money in its account and be positive traders. That is much better because it means you place more trades. Okay, so it seems we've answered all the questions on there. I hope everyone's found this fairly worthwhile. I'm just going to open up the next page. I hope everyone's found it worthwhile, and it's the first in a long line of webinars and seminars that we're going to be doing. So I'm just going to open up the website here. I'm just going to give you the trading center now. Sorry, I apologise for my ugly mug being on this page, but this is the webinar sign up page. Now you'll get another email showing what's going on and who's doing what and how and when the next webinars are going to be. The next one is next week, okay, Wednesday the 3rd, again 12 to 1 p.m. We're actually not going to talk necessarily too much about about Forex or anything like that. We're going to talk about the global crisis, what's going on in this global crisis, and how to trade it. Again, that's going to be a key point. I think a lot of people want to know, God, what's going to happen in the markets? And as I said at the start, no one necessarily knows what the market's going to do. But what we're going to do here is almost talk to you about how best to position yourself. So by all means, please sign up for that webinar. That will be next Thursday. Next Wednesday at 12 to 1. Week after that, MT4 tutorial. Week after that, introduction to technical and fundamental analysis. So this is almost like a beginner series. We'll have a week or two break, and then we will get have a little look and get the next set of webinars up. Be a little bit more in depth. Okay, we've had a couple more questions here. If you could just bear with me a second. So when and where can we get the recorded webinar? So straight after this, we are going to package it up, and it will go on our Trading Essentials page. And where there is a sign up button for the Introduction to Forex page, you will see there will be a YouTube video here, so you'll be able to watch it live on this. Hold on 2 seconds, reading a couple more questions. Vincent, I don't quite understand your question, but if you can, by all means, if you send an email through to me, I am I don't have anywhere to type it up here, so but bear with me. What I'm going to do is I'm going to type it in the address page, address bar at the top. So, right, so right at the very top there is my email address in the address page. Sorry, I didn't think about where I could type that in, but by all means, send me an email if you have any questions at all, and I will do that. So Vincent, if you send me an email, I'll answer your question on there. Apart from that, everyone, thank you very much for your time. You'll be able to look at this Introduction to Forex video, hopefully some point tomorrow. Most probably won't be today. But if you could, please, by all means, sign up for that next webinar, How to Trade the Global Crisis, next Thursday. Sorry, I keep saying Thursday. Next Wednesday, 12 to 1, same time. Same place. We will talk about this global crisis and how best to position ourselves in it. Apart from that, thank you very much indeed, and I hope to see you again next time. Thanks a lot.